All right, everybody. Today we are going to go over the different types of life insurances. This will be in a Word doc in the video, but there will be a PDF once this rough draft is finalized and the video is concluded. It should be anywhere on the page that you're viewing this video. There should be a PDF with all of the content that I have in this Word document in there. So the table of contents, what we'll be going over today, we're going to be going over a comprehensive breakdown of the different life insurance types, or at least the most common ones. What's covered in this breakdown is whole life, mortgage protection, term life, universal life, variable life, as well as final expense. And lastly, we're going to be going over how to sell concepts over selling straight coverage. So we want to go over why it's important to sell clients on a concept rather than just sell them a number, which we'll dive in deeper a little later. Introduction. So what is life insurance? By now you should know, and if you don't know, it's basically a contract between the policyholder and the insurer. The insurer provides a death benefit to the beneficiaries upon the policyholder passing away. Why is life insurance important? Why do people get life insurance? Well, it provides financial security for the family or their dependents. It could cover their income for a set amount of time. It can cover their mortgage for a set amount of time, for the entire term, for the entire mortgage, half their mortgage, whatever the case may be. It is meant to provide peace of mind for the family so that they can grieve without having to worry about how they're going to pay for the home, how they're going to replace their income, and all the other stresses that come with devastating death. People also get it because the life insurance itself is tax and probate free, and there's a lot of benefits to it as well. The different types of life insurances are term life, whole life, universal life, variable life, final expense insurance, which can be in the form of a term or a whole life policy, and mortgage protection, which can also be term or whole life, but majority of the time it's under term life. So term life insurance. Term basically provides coverage for a specified period. For example, 10, 20, or 30 years of coverage. So if somebody is 30 years old and they get a 10-year term, they're covered up until age 40. 30 plus 10 equals 40. So in that 10 years, they are covered. After the 10 years is up, that policy terminates. Hence, that's where the word term can be derived from. That's the best way to memorize it, is that term terminates. It's derived from the word terminate. How it works is premiums are paid for the term, and the death benefit is only paid once again if the policyholder passes away within that time frame. Most mortgage protection, if you hear that term or if you see that terminology in their policy, it can be sold under term insurance, which it usually is majority of the time. Term can be in a form of a decreasing term, a renewable term, which means the term can renew at certain ages, or it could be a non-changing term, both in terms of price and coverage. I feel like I'm using the word term too many times here in different contexts, which we'll go over in a diagram. I'll draw all this out for you guys, so don't feel like you have to memorize everything or understand everything. If you're more of a visual learner like I am, the demonstration, I'm not Picasso or anything, but you'll be able to understand what I'm saying when I draw everything out. What are the pros of term? Why do people get term coverage? Initially, because it's lower premium typically, and it gives them a lot more coverage. It's simple and it's straightforward. It's meant for younger individuals. They typically have temporary concerns like mortgages, debts, things of that nature that they worry about in their working years. What are the cons? Well, there's no cash value in the term, whereas in variable insurance, which is not as common anymore, and universal as well as whole life, all of those policies accumulate cash value over the years of you having it. Some policies more aggressively than others, but that cash value can be loaned or it can be completely cashed out, which we'll touch on a little later. But with term, they don't have that benefit whatsoever. They can't loan the money. They can't take out the money. They cannot touch the money unless they're dead, unless they have a rider, terminal illness rider, something that pays out if they're critically ill. But as far as cash value, term life, majority of the time, 99% of the time will not build any kind of cash value over the life of the policy. So we're going to go over what the decreasing terms were, the terms we mentioned earlier, decreasing term, the renewable term, and the non-changing term, right? And sometimes these can be under different terminology. I know it's confusing, but you want to dive into the policy and see what it specifically says and how it works. So let's start with, what's going on here? Decreasing term. How this product works is, in this example, let's just say Tom gets a policy at age 30 for $300K. And he got a decreasing term. What that means is, with time, and let's, for simplicity's sake, we're going to say every 5 years. The years are not exact. You got to check the policy. But every 5 years, this term decreases. So every 5 years, let's just say the term decreases by, you got 1, 2, 3, 4, 5, 6, call it 7 years. This could be a 10-year term, it could be a 7-year term, it could be a 20-year term. In this example, it is 7 years. If this is a 7-year decreasing term, then you take 300,000. Every year, this policy will decrease by $42,857. Every year up until it gets to this point, there will be no more death benefit. The policy will terminate. This is a hypothetical example. We're doing a 1-year increment. It could be a 5-year increment. It could be a 10-year increment. They have a 30-year term, and every 10 years it decreases. The specifications change. You got to check the policy or call the carrier for the specifics. So we explained what a decreasing term is. It decreases incrementally until the policy reaches its end of the term, which in this case it's 7 years, and it will completely terminate, and they won't have any more coverage left. So that's how a decreasing term works. Next, we're going to go over a renewable term. So a renewable term works like this. We're going to use Tom as an example. Tom gets a policy again at age 30. At age 30. I'm going to start down here and you'll see why. He gets a renewable term, usually automatically renews. Automatically goes up in price and the term period renews. Let's call it a 5-year renewable term. It could be a 10-year. Again, the years are irrelevant. What's relevant is the terminology of the kind of policy it is. So let's just say this one's a 5-year renewable term. So what happens is, start at age 30. Every 5 years, the price goes up. So if it started at $100 at age 30, hypothetically it could go in 5 years to $175, say in another 5 years to 279, say in another 5 years to 350. And then what could happen is that depends on the renewable term type. It can either completely fall off, terminate completely, or it can skyrocket through the roof. And it could be, say, hypothetically again, as high as $1,500 a month, because they are renewing the term based off the individual's age. So age 30, so at 35 it goes up, at 40 it goes up to 279, at 45 it goes up to 350, at 50 it goes up to $1,500 a month. Again, hypothetical numbers, but I have seen renewable terms that have exceeded $1,500 a month, depending on the coverage amount and the age that it renews. And I've seen renewable terms that renew up to a certain age and then again completely terminate, and they don't have the coverage anymore. Okay. Now we're going to go over let's see what we have left. A standard term, a non-changing term. This is just a straightforward term policy. And how it works, so just call it standard. Maybe it's not called standard. It could be called anything. We want to check for the type of policy it is, but just a regular term policy that they get, say at age, we'll change the age up this time, 40. They get it at age 40, nothing happens. Price and coverage stay the same. Then say at age 50 it terminates, 60, 70, depending on if they got a 10, 20, or a 30-year term. It just terminates at the end of the term. So price doesn't change, coverage doesn't change. It stays nice and steady, just like we saw in this example, and it terminates. A lot of term policies are standard policies. Again, it's best to call the carrier to get the specifics, or check their policy. Have the client check their policy, and if you're doing it over the phone, they can explain to you what the verbiage says, and you'll be able to better understand from there. Or they could send you a picture of it, but you could usually just get them to tell you what it is over the phone, and you'll get the gist of it. Oh, wrong one. Whole life insurance. So what is whole life insurance? It's permanent life insurance providing coverage for the policyholder's entire life. Main difference is term terminates, whole life doesn't. It stays for the entire lifetime of the insured. Premiums are fixed. They're generally higher than term life. They get less coverage than they would for term at a higher price, because obviously they lock in their age, they lock in their price, and they lock in their health, meaning if their health changes or deteriorates, or they get diagnosed with something that no longer qualifies them or would typically rate them a higher premium, it doesn't change because they took preventative measures and locked in the whole life prior to any of the conditions that arose throughout the time that they had the policy. There's a cash value benefit. It's a component to the policy that grows over time. So the more they pay their premiums, the more their cash value grows. This cash value can vary from policy to policy. Usually they'll take a chunk of, say, call it $100 a month. They'll take a chunk and set it aside for risk assessment in the case that the individual passes away, and then they'll take another portion of it, the smaller chunk, and put it in the member's cash value bucket, and that will grow with time. So they won't become extremely wealthy. They're not going to get aggressive returns. It's more so cushion in the event that they want to loan against their policy one day, because if they take that cash value out, they're just loaning against their death benefit, which we can explain a little more thoroughly. Or they can say they have the policy for 20 years and they just decide, you know what, I don't want this anymore. They can check the cash value and surrender the policy for the cash value amount. So the death benefit is paid regardless of when the policyholder dies. Doesn't matter if they die the first day they get the first day they get it, or 30 years down the line, 40 years down the line, it'll pay out regardless. The benefits, the pros are you get lifetime coverage, you get cash value accumulation, you get fixed premiums and price. It cannot change on the client due to health or age or anything else. Everything is locked in. You lock in the age that you got it, you lock in the health that you got it at, you lock in the price that you got it at, and it pays out no matter when you die, and it stays for your whole life, your entire life. That's why they call it whole life. The cons to whole life, I would say, is if your client is looking for an aggressive return on their investment, cash value wise, this isn't the right product. I personally don't sell anything solely based on cash value or a return on their investment. I sell security. Your life insurance is meant for achieving security and peace of mind for the family. I don't look at it like something that you become extremely rich off of. You know, it's not the right product for that. We have a life insurance license and not a Series 7 license to, I guess, play with people's money essentially. So whole life is usually pretty straightforward. Say Tom gets a whole life policy for $50,000 at age 30. What happens is he pays into the policy over the years. He'll have let's just say this is a bucket. Bucket of cash value. Not every single dollar he puts in. Remember what we said earlier. A portion of the money, the bulk of the money, is for the risk assessment in the event that he passes away. And a smaller portion goes into this cash value. There's no exact number. There's no standard percentage across the industry. You have to check the policy that you're selling. Ask the carrier directly if you want to know the exact amount. And that's the best way to find out how much cash value the individual will have. Every policy you check should have a table of some kind, a grid, a chart in the policy if they have whole life that tells you how much cash value they have. It'll usually say day 0, and then it'll say 5, 10, 15 years. They'll have 3K, let's just say 10,000 in 10 years, or 15,000. Again, these are hypothetical. It'll say the years that they've had the policy, or it'll say the age. So if they got it at age 30, this would say 35, this would say 40, this would say 45 hypothetically, and how much cash value they'd have. So whole life is straightforward. You get it in at a certain age. In this example, age 30, you have 50,000. Price doesn't change. Value, coverage doesn't change. Everything stays locked in, and it doesn't terminate. It stays for the rest of your life. Some policies automatically pay out when the insured turns age 100. Again, not terminate. It pays out the entire death benefit at age 100. And another common question agents have is, does the client get the coverage and the cash value? No, it's either or. They either cash it out and surrender it. They surrender the policy and they get all the cash value. So they'll surrender the 50K and they'll get whatever cash value they have. Say they only do that usually in, they had it for 20, 30 years. They no longer need the insurance. They want to cash it out. They call it a day. Or they keep the policy in place and wait till they die or reach age 100 if the policy states that at age 100 they get paid out. So again, they either get the death benefit or the cash value, not both. So that's how whole life works. It's pretty standard. It's pretty straightforward and to the point. It's a very popular product due to the simple fact that it's very simple to understand, and like I said, it's very straightforward. It doesn't have 1,000 ways that it works. It's just one way. It stays your whole life. Rates don't change on you. You lock in your age. You lock in your health. And it stays for your entire life. Once you pass away, your family gets paid out. Usually costs a little bit more. You get a little bit less in coverage in comparison to what term would cost, but that's what, you get what you pay for. It doesn't terminate, and there's a 100% chance that the carrier has to pay out. Universal life. So this is where life insurance can get a little more complex. There's not one single diagram on how this works. But universal life, basically it's a flexible life insurance product. It offers adjustable premiums and death benefits. So the client can play around with their policy. Depends if they want more cash value versus more death benefit. This one usually depends on what you select when you're building out the universal life. In these packages, you build them out. You get to modify them. Like I said, there's different options you choose for the client instead of just selling them a whole life product or a term life product. This one you get to customize day one. You get to maximize the death benefit, or you get to maximize the cash value if your potential client is looking for a return on their investment over the security and peace of mind knowing that they have a death benefit in place, which we'll try to explain shortly here. Cash value grows based on interest rates and market performance. Policyholders can use the cash value to cover premiums, which is another benefit. Or it could honestly be a bad thing in some cases if, they don't replenish the policy. There could be a chance that it completely lapses, which we'll also get into. The benefits are flexible premiums, like we mentioned, and flexible death benefits. They get to choose which one they want to prioritize. They have the potential for higher cash value growth, like we mentioned earlier. The cons are interest rates might fluctuate. So if they don't have a guaranteed floor, a guaranteed minimum interest rate, then that could jeopardize their entire policy. And the complexity of it in comparison to term or whole life is night and day. So policy can also not be guaranteed if there's no minimum death benefit promised. So there isn't one standard way of explaining this. Every single company has their own type of universal life product. I've never been an advocate for universal life. It doesn't serve our blue-collar workers. I think it's more so meant for individuals that are looking to invest their money aggressively with some form of safety and security, just not 100% protection. But to sum it up, basically, you get a policy day one. Say you're age 30. You get to either choose to maximize cash value or maximize your death benefit. This is money you get while you're alive. This is money you get when you die. If there's no minimum guarantee, what that means is if the market doesn't perform and there's no minimum guarantee in place, both for their cash value or their death benefit, that means they could lose their entire policy. They could lose all of their cash value, and they could lose their entire death benefit. So when they say the client gets to choose their premium, for an example, is say they want to pay $179 a month after having a policy for a couple of years. The company will let them do that, but that'll either eat away at the death benefit or it'll use up the cash value to compensate for the difference. I know this sounds complex. Again, it's not something I recommend to my clients. It's not something that I personally am an advocate of. I'm not saying it's a bad product altogether. It's just not a preferred product for me to sell. It's very complex and it can be tricky if you don't read the fine print. But if there is a minimum, then what would happen is the company typically will promise them, say they wanted $300,000 day one, hypothetically. This is what they enrolled in, right? This is what they got in place for coverage when they bought the policy. If there is a minimum guarantee for their death benefit, let's just call it $50,000. There's a minimum of $50K. Then if the market doesn't perform and they typically would lose everything if there was no minimum. The carrier saying, hey, look, the minimum we'll promise you is $50,000 to pay out to your family. There also could be a minimum cash value. So you could look in the chart we mentioned earlier for similar to whole life, as far as the chart goes, and it'll tell you at age, say he got it at 30, at age, call it 50. Say the market doesn't perform for whatever reason. We go into prolonged depression, recession, economic distress. There could be not only a minimum death benefit and or a minimum cash value that's promised to the individual. And if if the market was performing well at 50, in cash value, hypothetical numbers, guys, $100,000 is promised. This is a great market, right? If we're, again, in economic distress, recession, depression, there's going to be a minimum. So this is considering a great market. Should be another column to the right of it, somewhere on that page, or on a different page. It'll say minimum guarantee. Hypothetical numbers, 10,000. So worst case, Roger or Tim or Tom, whoever has this policy, if the market doesn't perform and there's economic distress and the entire world's flipping upside down, the minimum the carrier is guaranteeing you in cash value, money you have while you're alive, is 10,000. But if the market's doing great, it could be 100,000. These are hypothetical numbers. Guys, there's so many different variations of this. It could be very complex to understand. It could be very misleading if you don't know the product to the T, if you have not ran an actual illustration, which should be available in your carrier portal. We don't prioritize this product. We don't really sell this product. There's probably less than 10% of all of our business is IUL, Universal Life, and less than 1% is Variable Life, which we'll touch on next, but it's very similar to this. Moral of the story, we're only going over this so you know what your client has, and you could read the verbiage or call the carrier and ask them, hey, is there a minimum death benefit? And they're going to say no. The client most of the time will say, damn, I thought that I was guaranteed something that there was at least going to be a minimum for. Or they say, hey, there's no minimum cash value. The market cannot perform and they'll lose everything. A lot of IUL products I saw would have no minimum on either or. I've seen that a lot of times. And I've seen it at times where they'd have a minimum death benefit and a minimum cash value. So many variations. Call the carrier direct. Read the verbiage from the policy. Have the client read you them. And this is a way to attack a potential IUL policy if your client has this in place. Or not even attack. You can just sometimes educate them and let them know how their policy works. So with that said, the next type of coverage we're going to talk about, let me go and do that right now. The next type of coverage we're going to talk about is variable life insurance. And how variable life insurance works, somewhat similar to universal life, maybe even more complex, to be honest with you. And here I am doing this again. Nowhere near as common. This product is usually meant for financial advisors, wealthier individuals who have a high risk tolerance, that don't really care for life insurance as much, but they see it as a benefit to have life insurance in place, and they want to take advantage of potential tax benefits, and like I said, leverage the best of both worlds. Aggressive gains, higher risks, and leveraging the benefits of life insurance in general. For this one, the reason why I'm not going to do a diagram on it, if you guys look it up, there are so many different variations and complexities. It's hard to keep up with it. And like I said, less than 1%, if any percentage of our business has ever been variable life insurance. We don't have, to my knowledge, MRFG has not contracted with any carrier that, at the time of this video, provides this coverage. So it's not something you should worry about learning how to solicit. And our clients are not fit for this type of product, like I mentioned earlier. It's meant for individuals that are wealthier and have a higher risk tolerance. I'm almost done erasing this here. I know there's a faster way, but we're not being tech savvy today. Policyholder chooses from a variety of investment options, stocks, bonds, etc. That's what I was saying earlier. It's a lot more complex, more of an investment product than it is a life insurance product. Cash value is subject to market performance, which is also very finicky. And our members, our clients and demographic, we usually solicit peace of mind and security, a death benefit that pays out. We're not selling investment products here. Death benefit may increase or decrease based on performance of investments. That's also, like I said, very finicky. The potential benefits, you got potential for high cash value growth and flexible investment options. And the cons are, there's a lot more cons than just these two cons. Higher risk due to market performance, complexity, and potential higher fees. There's a lot higher fees associated with these kind of policies, And like I said, they're generally extremely hard to understand and put together to begin with, and they're not meant for the demographics that we are serving and soliciting. Final expense insurance. So what is final expense? Final expense is a type of life insurance designed to cover end-of-life expenses such as funeral costs, burial, cremation, usually meant for the ages of 40 to 85, but it's not tied to that age group in particular. Somebody 20 years old can simply want a final expense policy. Like our Premier carrier has that option for a 20-year-old to get a final expense policy, where a majority of carriers will only allow a certain age group. It's usually sold under whole life. What we mentioned earlier, it's the term final expense is not a type of policy, but it's becoming a type of policy from a marketing standpoint. Like people are, when they would say, I want a final expense policy. You'll tell them, you want a whole life? They'll say, no, final expense. So it's becoming its own product, essentially. That's why we're touching on it. How it works, it's typically a smaller death benefit. The most I've seen a final expense policy go up to is like $45,000, $50,000 for one carrier. You could sell multiple carriers, obviously, to beef up the coverage, but let's focus on just one carrier. It could go up to $50,000. With our Premier carrier, it goes up to $30,000 as of this video. So that's more than enough to cover somebody's funeral and their final expenses. Simplified underwriting, fewer health questions, so no saliva, no fluids, no full underwriting, which we could have touched on earlier too. So for the other products, depending on the carrier, they could go through a thorough underwriting process. With majority of our carriers, it's instant decision. So no nurse needs to come out, no nurse needs to take blood, urine, saliva, anything of that sort. There are carriers out there that make members go through an entire underwriting process. It could take 8 to 12 weeks to get a decision. Again, most of our carriers will get us an instant decision. And either yes, they're approved, hey, we're referring this to underwriting, but no saliva, urine, or specimen is needed, or hey, unfortunately, the client doesn't qualify at this time. So very straightforward. We don't do full underwritten exams like a lot of carriers do. The pros of it, easy to qualify for, provides a quick financial relief to cover funerals and other final expenses. I would also say that sometimes it can come with riders. It's easy to understand. It's simple. It's straightforward. The price is locked in. There's a lot of pros to it. The cons, limited investment growth. I mean, is that really a con if somebody's not looking to get extremely wealthy off of this? We sell life insurance, peace of mind, stability, and security at the end of the day. We don't really care for being financial advisors or stockbrokers. That's why we have a life insurance license and not a Series 7, right? The type of final expense, you may hear of products like guarantee issue or graded. So what guarantee issue generally means is the policy has a 2-year waiting period. If the client dies within the 2 years of obtaining the life insurance, the beneficiary will only get the full return of premiums, sometimes with an extra 10% on top to help sell the product better. So for example, Mary has $10,000 of guaranteed issue coverage. She dies 8 months into her policy. She's paying, say she was paying $200 a month in premium. Her family does not get the $10,000 of coverage that she initially got because she died within the 2-year time frame. There's a 2-year waiting period for guarantee issue. Her family will get $1,600 because she paid $200 a month for 8 months. She gets $1,600. In this particular policy, she gets an extra 10%, which in this example equates to $160. 1,600 times 0.10, which is 10% in the decimal form, you get $160. The total the family gets is $1,760. And how we got this number, once again, is they got 8 months worth of premiums at $200 a month, which is $1,600, and they got a 10% bonus, which is $160. 160 plus 1,600 is $1,760. That's what pays out to the family. The 10% is an incentive for people who would rather not have life insurance and would rather save their own money in the bank account. So some people tell you, why would I want that policy? I got to wait 2 years. I'll just save my own money. Well, if Mary, you die tomorrow and you have $100 in your savings account, what's that $100 going to do for you? Well, hypothetical numbers, guys. That $100 in this life insurance would have got you 10% more. No savings is going to get you 10%. Last I checked, any checking or savings, the highest I've seen is 5% if you're lucky. So and again, Mary, if you put that money for 2 years, you're still not going to have $10,000, which the full death benefit pays out $10,000 in this example. Graded. The best way to explain this is that it's broken up in tiers. It's a chopped up death benefit. So, for example, Mary has a graded policy. If she enrolled in $10,000 of coverage, she bought a $10,000 policy. Year 1, she only gets 25% of that death benefit. For year 2 for this graded policy, she gets 50% of the death benefit. Year 3, she only gets 75% of the death benefit. Year 4 and beyond, she gets the 100%. She gets 100% of the death benefit, which is $10,000. So to further elaborate, if she was sold a $10,000 policy, year 1 she gets 25%, which is $2,500. Year 2 she gets 50%, which is $5,000. Year 3 she gets 75%, which is $7,500. Year 4 and 5 and 6, and for the rest of her life, if she passed away, she gets 100% of the death benefit, which is $10,000, because that's the $10,000 that she chose when she bought the graded policy. Calling carriers and or checking policies is the best way to check the coverage types, amounts, cash values, everything that you need to know. If you're comparing everything side by side, it's very simple and straightforward. Type of life insurance is on the left side here. The premiums, we'll go through this from left to right. So the type of life insurance, if it's term, the premiums are generally low. The coverage duration is temporary, so it terminates. Sometimes it's 10, 15, 20, 25, 30 years. No cash value 99.9% of the time. Flexibility, no flexibility on this type of policy. Complexity, it's not complex whatsoever. It's very easy to understand. Low complexity for this type of product. For whole life, the premiums are usually higher. I want to say high. They're higher. Coverage duration, permanent. They have it their whole life, hence why it's called whole life. Cash value, it builds over time. Flexibility, they get fixed premiums. And complexity, there's not complex whatsoever. It's simple, it's straightforward, it's easy to understand, it's easy to teach, and like I said, it's simple and straightforward. Universal life, not a fan of it personally, but we're going to go over it. Premiums, they can start off moderate or they can start off high depending on what they elected, if they are prioritizing building cash value or if they're prioritizing having a higher death benefit. It just depends. Coverage duration, it's not always permanent like we discussed earlier. Some of them are permanent if there's a minimum guarantee, if there's a minimum guarantee for their death benefit. And sometimes coverage can fall off at a certain age. Just depends on how that policy works in particular. Sometimes it depends on the market's performance. It could depend on a lot of things, guys. So ultimately, you can't guarantee somebody they will have coverage no matter what, unless there's some kind of minimum guarantee in the policy. Cash value, it grows with interest. Flexibility, I guess you could say the flexibility portion of this policy would be the fact that they can adjust their premiums or their death benefit depending on the type of universal policy they have. Complexity, obviously extremely high. It's very hard to understand, very hard to teach and to go over. Sometimes just looking at the policy and how it functions is extremely difficult to go over. Variable life, very high premium usually. Coverage duration, not always permanent. Again, there's different complexities and things that could affect it, like the market's performance, what the insurance company decides to invest as far as a product portfolio, cash value, again, based on investments made, flexibility, adjustable premiums, and some other things depending on how the policy works. Complexity extremely high as well, if not just as bad, higher, more complex than universal life is. Final expense, again, can be in a form of term or whole life. Premiums can be low or moderate or high. Honestly, this should say all three: low, moderate, or high, depending on age, depending on health, depending on the type of product. Remember, we said guarantee issue, straight, whole life, or modified, graded, whatever the case may be. But usually they're pretty reasonable. They understand seniors are on a fixed income. This final expense product usually meant for older people. They're not going to make it unaffordable, nowhere near what any of these other ones would be. Coverage duration, permanent. It's locked in, stays for the rest of their life, doesn't change. Cash value, it can, this we're going to change, it can grow cash value based on, this is not editing right now, so ignore this none, but it can grow cash value if it is a whole life policy. So it depends on coverage type. That's what this should have said right here. Depends on the coverage type. It can grow cash value, and it usually does in most cases. If it's a whole life policy, which generally it is, it will grow cash value. If it's a term life, which some of the final expense products are, there will not be any cash value. So this here should say depends on coverage type. Flexibility, again, depends on the coverage type. Usually it's simple, it's straightforward, it's a fixed premium. If it is a whole life, it can be a fixed premium if it's a term life and that terminates at a certain time, doesn't change. But generally speaking, it does depend on the coverage type. And again, majority of the time, that coverage type is a whole life under the term final expense, the terminology of final expense. Complexity low. It's very easy to understand, to get down, to teach. It's simple. It's straightforward. It's literally the same way we explain whole life, because considering majority of the final expense policies are whole life. These are just considerations. Why they get the policy to begin with. Is it because of their budget? How much can they afford in premiums? These are usually questions that they're asking when they're qualifying the prospect. Are they looking to get long-term coverage? Are they looking to get for a specified time? This just helps you guys understand why they got this policy to begin with, or what questions to ask the client, like, hey, why did you get that policy, this term policy? Was it because it was cheaper at the time? Was it because you're looking to cover your home? That's why you got a term. These are questions that you ask. Hey, why'd you get a guarantee issue policy? What's your health looking like? It more than likely affected your premium. It affected the fact that you got guarantee issue, or they're no longer sick or have a health condition and they could qualify for something standard and straightforward. These are, again, questions that you can ask or were asked before they got the policy in place to begin with. So with that said, we have one more thing to go over, which is selling concepts versus selling straight coverage. The best way to put this is, if you're sitting down with somebody, or selling them over the phone rather, and you're talking to them and you're just telling them, hey, let's just get straight to the point. There's no presentation. There's no psychological, emotional influence. It's just, hey, you need life insurance. I can do $10,000 or $20,000 for you. Which option do you want to do? They're going to say, what's the price usually? Price, I can't even draw right now. They're going to ask you, yeah, let me just get the price on that. So anybody can ask the client, what do you want, 10 or 20,000, and start off a call and try to close them in 30 seconds. But generally speaking, they're gonna say, okay, well, I'm gonna think about it. I'll talk to other representatives. There's no presentation. There's no important fundamentals. There's no structure that leads the client from a logical reasoning to want insurance, to an emotional influence that makes them need the insurance while you're on the call. There's a lot of things that go into this. Your intro typically, proves you're a reputable person. You're credible. You represent credible carriers. You get straight to the point. Let them know what it is you're doing. Sometimes you plant the seed, then you transition. Right? This is where the concept selling kicks in. The emotional part kicks in. For an example, if somebody has a mortgage, they were sold on mortgage protection because this home here is something they worked for their entire lives. They could have 5, 10, 15 years of their life saved up for it, moved into it. Then John ends up croaking, passing away, and the family has to worry about relocating now and finding somewhere more suitable, more affordable. This is just a burden, a devastation they have to deal with, on top of the fact that they're grieving over, the main bread earner's death. So this is why it's extremely imperative to sell concept over just selling a number. Anybody can sell a number. Once you sell a concept, then you tell them what the number is. So if you're selling a senior citizen, right? You got John and Mary on the phone. You tell them, hey, John, you're the bread earner. You're making $2,000 a month between your pension and Social Security. Mary's making $1,000. You pass away, half your income's already gone. How is she going to cover your funeral when you croak, when you pass away? It's devastating. We have to make sure that the funeral and final expenses are taken care of today. That's the reason why you requested this, right? So that, again, in the entire presentation, there's going to be a point where you're tying them down and asking them questions like, why did you get the coverage? They're going to sell you themselves on why they did it, why they got it. So now you have ammunition to use against them and to paint the picture and create more urgency for them to get this taken care of. Sell concept over coverage. Once he agrees to say, yep, I need this in place for her to have peace of mind when I pass away, this is when you say, okay, for your funeral and for your final expenses to be covered and for supplemental income to be remaining for Mary, we're going to get you $30,000 of coverage with something called whole life. This is when you get into the numbers, into the type of product, but you sell concept over everything. People understand concept. It gives them a visualization. It helps them picture circumstances in their head versus $10,000 of coverage. That has no emotion. It has no value. It has no visualization for them to visualize their life. 10,000 is just a number to them. It's just a cover. It's just something that anybody can tell them, or they can see that number anywhere. Versus painting the picture, creating the distress and devastation that Mary's going to go through, losing half of his income. What are you going to do, Mary? How are you going to get by? You guys are saying times might be tough now. They're going to be much tougher when she loses half your income, the majority of the income. The main bread earner's gone, and now she has to figure out how to still put food on the table, buy groceries, keep the bills covered. And if they have a mortgage, for an example, it's all circumstantial. How is she going to cover that mortgage now? Dude, we're already talking. She's negative, $1,700. She only has $1,000. What is she going to do? This is something we have to make sure we get taken care of. Guys, when you say things like this, when you sell concept, when you paint the picture, it is going to help you get the sale majority of the time. If it's not a spouse and it's kids, you tell them about the kids. And just as a bonus, guys, if they mention, hey, I have to talk to my kids, insurance is a gift of giving it forward. This is not something that, say, you can tell them this, for an example. If my mother called me, which is you as the agent, you're telling this to your client, my mother called me today and asked me if I should get life insurance in place, I'm going to feel guilty telling her yes. Deep inside, I know she needs to have it, but this is something that we gift them without even letting them know. So I respect the fact that, Mary, you want to get your kids involved. This is something you put down. Usually, it's something that people include in their will even. You pass away, this is how the life insurance is going to get dispersed. It's not something that you got to make them feel bad about. Let's get it in place, make sure they have the peace of mind. They don't deserve to feel this guilty feeling just because you're asking them, and knowing deep inside they need something like this in place. Right, Mary? So we'd rather, even if, let's just say, for example, that you did call them and they truly didn't, you'd rather have this in place and not need it than them need this policy one day when you pass away and they don't have it, right? We'd rather have it and not need it than need it and not have it. And I'll tell you one thing, Mary, every single time, I've never had a client mad at me for having life insurance in place and their family didn't need it. In fact, the complete opposite. They get upset that they didn't have something more in place. They didn't have more coverage in place because they find out that $10,000, $20,000 isn't enough. They thought it was. But at the minimum, it's better than not having anything, okay? So we're going to get this in place. We're going to make sure that your family has peace of mind, and this is the best gift you can consider you gave your family as long as you've been alive. It's a gift of peace of mind for when you pass away, to know that everything's going to be handled and that financial burden doesn't have to fall on your children. They don't deserve to have to deal with that on top of the fact that they have to grieve over your death, which is going to be extremely difficult as it is, Mary. So again, guys, these are things that this is all conceptual selling. We're selling a concept. We are not selling coverage. You sell the coverage afterwards. You probably mention it once or twice, honestly, once they are emotionally influenced with your tonality being on point and everything else. So again, that concludes the training for today. There will be a PDF of this, a finalized version of this in a PDF format somewhere on the page that you're viewing this video. So with that said, wish you all the best. Take care.